Dean, first of all, how are you finding these interesting times? The market's bounded back pretty well. How have you handled that?
I think probably we're enjoying the ride at the moment, but it's been pretty unexpected. I don't think there was any doubt that the market had fallen so severely in February and March that people expected a little bit of a rebound, but there seemed to be a lot of economic uncertainty even into April. So the fact that the market's just continued to rebound with really not any pullback at all, I think has been quite surprising for nearly all market participants.
Do you think that's set to continue? I mean, there's discussion about U-shape, V-shape, flat, whatever it may be. What's the prognosis going forward?
What's been surprising, I think there was initially this talk it would be a V-shaped recovery, and then it kind of bounced back very, very quickly, and then everyone started talking about a W-shape. I think they expected another dip. That just doesn't seem to have happened. There's been a huge demand for a number of the equity placements that have come into the market. I dare say there's been a bit of a short squeeze on stocks, and I think as the market continues to rally, that participants seem more inclined to buy it. So like it really has for the last 2 or 3 years, it just seems to have a lot of momentum.
It's fair to say there's a lot of cash sitting outside the market waiting to come in the market, and we see that not only from funds and institutions and the buying that's gone on, but also from the private sector, self-managed super funds, etc. So do you see this continuing?
I think one factor that everyone potentially underestimates is the fact that interest rates have gone so low. They're almost zero. I think a 10-year bond now is 1/4 or 0.5%. And so there's no value in anyone leaving their money in any kind of interest rate or cash security. If they can put it to work, even getting a small dividend yield in the equities market and potentially getting a small capital return, that's attractive. So the propensity for investors to shift that money into securities that are yielding anything above zero is they're very, very keen to do it. And I think that's where the marginal buyer is coming in.
Dean, the Cyan Fund obviously focuses on the small cap end of the market. And as such, that's probably been a pretty good place to be, not only over the past few years, but significantly over the last month or two. I mean, it might have been difficult when the market was falling, but it's recovered pretty well, and you've avoided presumably the banks and the finance sector.
I think everyone realises that if you're running in small caps that you sustain a lot more volatility. That's obviously very enjoyable on the way up and very hard to take on the way down, and no one really ever knows where it quite turns. But the last 2 months have been incredibly good for the small cap market. Not just the extent of the bounces in the number of these small stocks, but the number of opportunities to deploy capital at very attractive prices in some of these businesses that are raising money. So, for us, we'll probably see 2 months where we're up kind of 10% in both, 10% one month and 10% the next month, which is probably two of the best monthly returns we've had in the 6-year history of our fund. Clearly, we've had some tougher times before that, but I think always you just don't want to be out of that market completely, because the returns you can get in a short period of time can be very, very material.
Dean, you've been obviously participating in some of these capital raisings. Can you give any indications that you think that'll continue, or maybe some examples of where you've been able to take advantage of that?
I think what's happened in terms of the capital raisings is you've had a number of these businesses look for real survival capital. I think Webjet was probably one of the main ones that really had to put their hand out for money at a very, very low price, and it's bounced back. Some of the others have probably been not quite survival capital, but probably just need to see them through the next 1 or 2 years. I think the expectation was the capital markets would only be open for a very brief period of time, but as the markets continue to perform really well, I think that window is probably opened a little bit wider. So there'll be an advantage to probably put a bit of money into growth capital as well. We've probably put money into 4 or 5 companies. We've put it into things like Aerometrics, Swift Networks, Atomos, QuickFee. And by and large, most of those returns on those placements are now sort of, 30 to 50, 100% higher than they were when we deployed that capital only 4 or 5 weeks ago. So there's been the opportunity to get some really, really good returns in the market.
Dean, one of your favourite stocks over the years has been Afterpay. Can you just tell us where you are with Afterpay at the moment?
Yeah, look, I mean, Afterpay's been probably the most successful stock on the ASX, if not globally, in the last 4 or 5 years. We were smart and or fortunate to get on there very early at $1 when it IPO'd, and decided to sell the last of our shares in that business at about $35 last October, I think it was. At the moment, it's trading up towards 50, so we've probably left $15 a share on the table, so maybe sort of 30%. But we don't really look at these stocks with any regret once we've sold them. It clearly would have been nice to have, kept holding onto them and sold out at the top. But I think it's a pipe dream for any investor to buy stocks at the very bottom and sell at the very top. You've got to look at a risk return basis with every investment. For us, we thought the upside was potentially not worth the downside, and have I guess moved on to other businesses, and we're comfortable with that decision.
Well, I always say you never go broke taking a profit, but in fact, if you took your profit at $35 last October, the stock then actually fell away quite significantly. So could argue you've made exactly the right decision.
I mean, what's interesting, we have actually had investors say, "Oh, look, you guys still in that? I thought you had you sold out." And we said, "Look, we did. We sold out at 35. It's trading at sort of the high 40s now, but it did trade from $38 down to below 10 and then back up. So even though we've missed a bit of upside from where we are now, we've avoided a hell of a lot of volatility that would have flowed through to the unit price of the fund, and so I think that's probably still been a good decision on balance.
But at the end of the day, I think you're there to protect capital as much as to make a return. So I don't think many investors would criticise you for that basis. Protection of capital is surely one of the fundamental aspects of managing other people's money.
I think that's right. It's all, we sort of joke that people love sort of volatility when it's working for them and hate it when it's working against them. I mean, that's just the nature of equities, that you are taking a capital risk every time you make an investment. I mean, it doesn't matter how blue chip or secure you think an investment is. So whilst we always, I suppose, on one hand look at businesses for the upside, we've also got to consider the potential downside in any business and have a very balanced view towards every investment we make, and judge that on a daily basis as prices and fundamentals of businesses move and change.
We just seem at this stage, we are end of May, and there are signs we're coming out of the tightest part of the lockdown. Do you see that that's just going to continue and markets will carry on from here on the upside, or is there the potential for a second down leg?
It's been interesting. If anyone had any misconceptions that the market wasn't a forward-looking vehicle, they've truly been dispelled over the past 8 to 12 weeks. The market really started running probably right in the middle of March when the fear of COVID was at its worst, and it's just kept going up as the economy has trailed in terms of its, suppose, opening up since then. I think what we would probably be concerned about here at Cyan is just when that government sort of spending, when the JobKeeper assistance kind of rolls off, when unemployment really takes hold, when we see a little bit of a softening, how that flows through to profits could be a little bit concerning. But at the moment, I think as I suppose life improves for everyone every day, it just seems that the market is continuing to be buoyed by that, I suppose, opening up and return to growth. So at the moment, it seems like a good thing. And as I said earlier, there just seems to be a lot of money looking for any kind of return above zero. So we tend to, on balance, generally be pretty positive at the moment.
Any other final comments you'd like to leave us with?
I think it's just shown, over the last few months, probably we've been through one of the most volatile periods of arguably my investment lifetime, is that you just have to sometimes accept that that's what's going to happen in terms of an equity market investment, and not get too excited at the peak and not get too depressed at the bottom, and right through the volatility. And it's easier said than done, but invest over the long term.
Dean Fergie, thank you very much for your time. Always great to talk to you.